Exactly a month ago today, the JSE Top 40 Index traded around 37,550 points, with the COVID-19 sell-off rippling across local and global markets. Today, the index has gained more than 20% from those lows, not far behind its global peers on Wall Street. Is the market signaling that the worst is over in the fight against COVID-19? We find out from our market analyst today, Byron Lotter, portfolio manager at Vestact, as well as Seleho Tsatsi, investment analyst at Anchor Capital. Gentlemen, thanks so much for your time. Straight question: is the market right? And should we be taking its cues that the worst of the COVID-19 sell-off and perhaps the economic fallout is behind us? Byron?
Yeah, I mean, the market is obviously forward-looking when economic data is always backward-looking. And don't forget, too, that a big factor of our market is Naspers and Prosus, which biggest underlying asset is Tencent, which is the biggest social media site in China. And things in China are sort of normalizing in terms of economic activity. So it's not really representative of the economic situation in South Africa. We've also got a lot of big rand hedges, and the rand sitting above 19 now. That's also had an impact on the market. But in general, we are following the global markets, and a lot of people think they're smarter than the market, saying there's definitely going to be another drop. But that's certainly not a given. There's so many moving factors at the moment, and you've just got to take it day by day and filter the right information, and base your investments on that.
And Seleho, what about offshore markets, particularly on Wall Street? Are the kind of moves that we are seeing across those markets more representative of the economy? Because we have seen the S&P, I think earlier this week, it was up almost 30% from its March lows, despite the fact that we have seen, a number of negative data points coming out of the US. Yesterday, we're reading that the number of people filing for unemployment benefits is a lot lower than we have seen in previous weeks. But is the moves that we are seeing on Wall Street indicative that the worst is over for the COVID-19 pandemic, or are markets moving ahead of themselves here?
I think similarly to what Byron was referencing with regards to Tencent and what's happening in China, if you look in the US, it really depends on the sector that you're looking at. So if you look at the technology sector, you have the so-called FANG stocks really outperforming, as people infer that obviously we're staying at home more and spending more time on our devices. And so these companies should, in theory, do well. Although in some cases like Facebook and Google, you have a lot of exposure to advertising. But if you look at some other sectors within the S&P 500, for example, obviously the oil sectors or energy sectors under massive pressure. And so I think just using those two sectors as sort of a most extreme case on both ends, I think it really depends on the sector that you look at.
And then I do understand that the Federal Reserve has really played its part here in making sure that there's enough money to go around in the system. I do believe that the Fed is even buying corporate bonds that are junk rated, just to ensure that there is enough support. We've also just recently announced a stimulus package, and I'm wondering if our stimulus package will go as far as that of the Fed in supporting some of the moves that we are seeing on the market. Byron?
Well, the size of it is about 10% of GDP, which is sizable. But don't forget that 150 billion of that was already in the budget spending. I think the economic stimulus is huge, is a huge factor in what we're seeing in markets at the moment. When we had the global financial crisis in 08, 09, the quantitative easing program that Ben Bernanke and his team implemented was unprecedented. And they had no idea whether it would work or not. And there was huge criticism about printing money, calling him the helicopter man, and that it would result in mass inflation and would not work. It did work, and we now know that it works. So we are fortunate in the sense that we've learned from past mistakes, and we've found solutions to fix certain problems. And at this rate, while the US is still printing money and buying bonds and interest rates are zero, we still have no inflation. And in fact, the dollar is strengthening. So there's still demand for their currency, despite the fact that they're constantly printing money. And this is propping up markets and hopefully giving markets and businesses and the economy enough stimulus and enough room to survive a prolonged lockdown until things start normalizing.
Seleho, you were talking about oil stocks there in the US, and I do understand that they have been under quite a lot of pressure, kind of the similar pressure that we have seen from our local oil players. I don't know if it's exactly the same, but what did you make of the output or the production report out of Sasol today, in which it said, there's more trouble still to come from Lake Charles. The picture is not looking too rosy there as a result of that unprecedented crash in oil prices earlier this week?
Yeah, so I think with Sasol, there's really two significant parts of the business that you need to look at. There's the underlying operations and the earnings that they're producing, which are under pressure due to the challenges that oil and petrochemical prices have. But then you also have the balance sheet. And they've gotten themselves into a difficult situation where they need to fix their balance sheet, in essence, at a time when oil and chemicals prices are under pressure. I think there wasn't any real major surprise in what they discussed today. They showed that their chemical volumes are ramping up, but at much lower prices as petrochemical prices come down. And as all of us stay indoors during this lockdown, liquid fuels demand is under significant pressure. So they're forecasting their liquid fuels volumes to be down by about 16% for the year. So I think we have a situation where earnings are under pressure, and really the market's just looking to see how successful they are with this asset sale program that they have going underway at the moment.
Talking about lockdowns and the possibility of a prolonged lockdown, even, Byron, I know that all over the world there's a few economies that are starting to open up, and a huge debates in the US currently underway as to when we get that economy up and going. Some would like it to be a lot sooner than others. A similar conversation we're expecting from our president later on today around the reopening of the economy. Taking this and bearing this in mind, what stocks, if you're keen on stocks right now, what stocks are you putting your money into as a result of the possibility of things coming back to a normality very soon?
I think it's very difficult for any company to not be negatively impacted by what's going on, because even if you're a Google, advertising spend is going to drop because there's just going to be less money going around, less people consuming, and less people with jobs. And we've seen that in the US in terms of their jobs numbers. So no one is really protected, but there certainly are good buying opportunities. Some stocks haven't fallen much at all. Netflix, Amazon trading close to all-time highs. I quite like, real quality companies with big cash piles, big moats around their business, but have fallen back a little harder than the rest. So a company like Visa, which is the most magnificent business, but has certainly been hit hard because less people are traveling and swiping their cards in foreign currencies, which is a big margin business for them, and less people spending in general. But I'm pretty certain that, once things start normalizing, people will start swiping cards again, and the shift from cash to card will continue. So you've got to be very selective and precise about where you're investing during times like this. So stick to quality, stick to blue chips, make sure that, your companies you're investing in don't have too much debt. But there certainly are some good opportunities out there.
And of course, that is if you've got the stomach for risk at this stage. We're speaking to a lot of money managers who are taking a really conservative approach and choosing to put most of their money in cash and also government bonds. But Seleho, if you're also dabbling on the riskier end, given that time is on your side with your boyish looks, like Byron, are you following in the tech space in the US? And perhaps you can comment on where you are seeing opportunity locally at a good value right now.
Yeah, so we tend to like high return on capital businesses that generate a lot of cash and have moats. So technology is a sector that tends to have those types of businesses because it's a winner takes all sector. Unfortunately, we haven't seen a sell-off in that sector to the degree that we have in other sectors, Fifi. So it's difficult to find valuations that look outrageously cheap in the technology sector. But I would point to a name like Spotify. That's a company that we've liked for some time. Uh, Essentially, they are looking to capitalize off of the transition to digital or online streaming of music. And they've got a CEO who's founded the business, still a material shareholder in the business. And as people stay home more, it's likely that we're going to be listening to more music, consuming more of their subscription service, and it's a very high cash flow, high margin business that should do well in an environment like this.
All right, so gentlemen, thanks so much for your time and the tips that you have given us for today. That was Byron Lotter, Portfolio Manager at Vestact, also Seleho Tsatsi, Investment Analyst at Anchor Capital.